Talk about mortgage-backed securities and CMOs. So first of all, a mortgage-backed security is just essentially a security that's backed by a mortgage. It's a secured bond that's collateralized by a piece of real property. So in general, there's various government agencies that will issue mortgages. So we're talking about like Ginnie, Fannie, and Freddie. I mean, there's also private label ones, and same thing with CMOs. But essentially how it works is as such. Let's say you have a mortgage that you get with one of the big mortgage companies, like Wells Fargo, Chase, Rocket Mortgage, etc. And essentially, if it's going to be a FHA loan, which is government insured, or a VA or USDA loan, those are going to be purchased from the various companies that issue mortgages. It's going to be purchased by Ginnie Mae, for example, because we talked about FHA, VA, USDA. So it's going to be bought by them. What they're going to do is then they're going to buy thousands of Americans' mortgages, and they're going to create pass-through certificates out of them. So essentially, Americans are essentially betting on, they're buying bonds that are secured by other Americans' mortgages, right? So the problem inherently with them is what's called prepayment and extension risk. So when interest rates go down, people will refinance, which essentially means is they're going to borrow a new loan, use the new money to pay off the old loan, right? That's called refinancing. And now what happens is now the investors are going to have reinvestment risk, right? Or prepayment risk. Prepayment risk is a form of reinvestment risk, essentially, because now you're going to get your money back early. And if you were getting, let's say, 6.5%, now you got to reinvest at 5 or 4 or lower. Or you could have extension risk. So for those folks who had mortgages in 2020, I know people who have like 3% mortgages. Are those people ever going to pay those 3% mortgages back? If it were me, I would take my sweet time. If I'm borrowing money for under market interest rates, I'm going to take my sweet time paying that money back as much as I physically can, because that's not offered anymore, right? And who knows when it's going to be offered. The expectation was that rates were going to go down soon, but it doesn't look like they're going to go down any sooner, and we could have the expectation of stagflation. So, yeah, you have prepayment and extension risk with mortgage-backed securities. And now, what are CMOs? CMOs are almost like side bets on the mortgage-backed security. So there's a concept called securitization, where you take a mortgage-backed security and you almost like securitize it even more. So you slice into different types of tranches. So one example is you can bet on just the interest or just the principal. So if you're betting on an interest only, if you do an IO type tranche in MBS, that means that you would want extension risk, right? And then if you because you're getting more interest during that time, or if you're just betting on the principal, you're betting that rates will go down and people will refi, right? So basically, you're creating all these side bets on the mortgage-backed security, and a lot of people argue is that that's what caused the financial crisis. Because if you have similar to the movie The Big Short, they talk about the whole casino situation where, if you have one bet and then you have 50 other people piling in, the original asset that all this is based on might be worth $1 million and the side bets might be worth $5 million, right? The best analogy I can think of with MBS versus CMO, MBS is almost like you're betting on a game, right? It's team A against team B. You're just going to bet money line, team A, team B. Now, with CMOs, it's more complicated, right? You can, or the same thing if you're long and short a stock, right? And then when CMOs are options, more complicated, you can start betting on point spreads. You could bet that, stuff's going to narrow, stuff going to widen, and all sorts of complex stuff that you could try to take advantage of. So CMOs are complex securitized products. And mortgage-backed securities are like the more simple one. And there's agencies that are issued, like Ginnie is the only one that's guaranteed by the federal government. Fannie and Freddie are not. So Ginnie's only going to be dealing with like FHA, VA, USDA, and then you also have like private label mortgages and CMOs. There's like builders, home builders that offer mortgages. There's obviously commercial banks. There's investment banks that offer mortgages. So hope that kind of makes sense. Please like and subscribe for more. Thanks. Have a good day.